Okay, so the latest CPI data, we got it in the US and it came a little bit under the expectation. It came 0.1% lower than what the market was expecting. So not a huge difference, but right after that, the market rallied pretty much everything like S&P, Dow Jones, Nasdaq, Bitcoin as well. And then in the later part of the day, the market kind of closed at the same level where we saw that yesterday. So the devil is always in the details. When we look at the inflation data, we realize pretty much all the inflation this month, actually last month, came through shelter inflation. And the funny thing is the way BLS in the US measures shelter inflation is not actually following the actual rent being published by Redfin or Realtor.com website, but actually they run a survey and call a bunch of homeowners and asking them, hey, how much would you rent your property for? And those homeowners would say, I don't know, it's 2-bedroom house, maybe $2,000 or maybe $2,300, who knows? So they use that information to kind of measure the shelter inflation. How funny is that? And then if you look at the core inflation, which means excluding food and energy, the core inflation is sticky. And that based upon the services inflation, which is driven by the wage inflation, which is still going higher, 0.3% month over month, and the consumable goods like retail products. And what we saw that if you realize by looking at the retailers' profits, you can see much of their profit margin is coming through the price increases. And last year we saw that those retailers were justifying the price increase because it was based upon the supply chain disruption and everything was getting expensive. Now they can raise prices like this and they don't have to justify, and nobody typically noticed that. So that core inflation seems to be sticky, which is a bad news for all of us, because Federal Reserve will not actually declare the victory until the core inflation comes down. Yes, the overall inflation is coming down because of the base year effect and all the other factors in the global macroeconomics, but the core inflation seems to be sticky, hovering around 4%, which is not really a good sign. Another point here is if you look at the bond market, the 10-year US Treasury, it's still hovering below 4% yield, right? Federal funds rate is reaching above 5.5%, but the 10-year Treasury is not moving above 4%. Why? I think the fundamental question here is maybe the bond market is still believing that Federal Reserve is bluffing on their narrative. And the bond market is much bigger. It's much bigger than the stock market. If the bond market is predicting that at some point the rates will come down, which is why the 10-year Treasury yield is not spiking above 4%. That seems to be kind of telling us that maybe things are getting changed, and at some point the 2-year Treasury, which is higher than 10-year Treasury, it actually reverses. So as the 2-year Treasury yield goes down below 10-year Treasury, this is where we have to pay very special attention, because this is when the yield curve gets uninverted. So right now it's inverted where 2-year Treasury yield is higher than the 10-year Treasury, but when this process becomes reversed, the 2-year Treasury comes under 10-year Treasury yield. This is when things basically hit the fan, and this is where we have to be very careful putting money in the market, because that would be the chaotic situation. So after that, then of course the recession will be officially declared, Fed will drop the rates, and then everything will start going back to the recessionary period. When this will happen, I don't know. Nobody knows that. But at least if you look at the bond market, especially the long-term bond yields are not spiking above 4% after all the macro pressures like the China situation, the Japan situation, when they actually increase their ban in terms of how they're controlling the yield using yield curve control. The 10-year Treasury is not really spiking up. Ideally, this should have gone up, because if all the pressure is coming onto US and everybody's dumping US dollar and dumping US Treasury, we should have seen the 10-year Treasury spiking like crazy, but we haven't seen that. That means there's still enough demand for US 10-year Treasury, which is keeping the yield at below 4%. And that could be another factor in the equation that we have to look into this before we put money into stock market. So anyway, this is just my observation. I don't think Fed has done yet. Maybe not. But if I look at bond market, I think they seems to be this seems to be done here. They will at least pause the rate hike now, but they are not cutting rates at this point. But that's just my observation. Let me know what you think. Put your comments down below, and I'll see you in my next video. Thank you.